Up next, we have our most popular panel discussions on market outlook, sharing across the opportunities and risks in the second half of 2017 and into 2018. It's our privilege to have with us Mr. Jeff Howie, market strategist from SGX, who will be moderating this panel. And along with him, we have Christopher Versace, CIO from Thematical Research, Joanne Gold, Vice President, Regional Equity Strategies Group Research from DBS Bank, Kian Soon, CEO, Astro Asset Management, and Tom Gardner, the co-founder of The Motley Fool. So without further ado, let's welcome them on stage.
Good afternoon, ladies and gentlemen, and thanks very much for coming along to our panel discussion, which we will kick off right now and run for the next hour. We have two guests to welcome into Singapore. We have Chris from Thematica, and we also have Tom from Motley Fool. So let's give them another warm welcome to Singapore. We also have Kian Soon from Astro Asset Management, a value investor that we're going to talk a lot more about his strategies and outlooks potentially for Singapore and the region. And we also have Joanne Go as well, who you know has been with DBS Bank since 2006 and oversees asset allocations, the ETFs and the regional equity strategy. So we're going to have a lot of, I guess, good local expertise, regional expertise, as well as some great global expertise. So we'll have a few questions. The panelists will introduce, talk a little bit about what they are doing as market participants, as well as we'll try to take some questions towards the end. And we do encourage you, if you can think of some good questions, please don't hesitate to fire them away. But okay, let's start with right from the end with Tom, he was a co-founder and CEO of the Motley Fool, which was founded in 1993. So next year, Motley Fool is having a 25-year birthday in Singapore. Remember, this weekend we are also celebrating the STI 50th birthday. It's Jubilee anniversary. And if you'd like to read more a little bit about that, there's plenty of information at the FTSE booth. So please do so. The STI has an incredible history as well. But let's start with Tom and ask him a little bit more about the Motley Fool business. It's an award-winning business. It's won a Glassdoor prize for a very highly engaged workplace with 250 to 1,000 people. And I think most of us would love to hear more about the model, which is the foundation for a lot of the great work David Koh and the team's been doing here in Singapore.
Thank you, Jeff. Well, yes, we started in 1993. And we didn't really expect to create a business. We just love investing. Our father taught us to invest as kids. We would go to the supermarket and our father would say, and this is a true story, maybe I was 5 years old and my brother was 7 years old. They would say, children, do you see the chocolate pudding brand right here on this shelf? And we say, yeah, Dad, yeah. We own shares in this company. And we're like, oh, so get more chocolate pudding. And we were like, I love investing. Investing is fun. We eat chocolate pudding all day. And that really taught us that the products around us were things that we could invest in. And the second thing our father did is sometimes when we went on vacation, he would tell us, I know you were expecting to go swimming today or playing some tennis, but instead we're going to get in the car and we're going to drive 25 minutes outside of town here in California where we were visiting. And we're going to meet the chief financial officer. Imagine maybe your 10-year-old self hearing this when you were ready to go swimming. You're going to meet the chief financial officer of a semiconductor wafer design company. And our heads would drop. And we would go and sit for an hour and a half while our dad interviewed their CFO, just as an individual shareholder. You really can do that. We all can do that much more than we think. But the important principle that our dad taught us there was that there are people running these companies. They're not these big, giant corporations that are divorced from our daily life. They're selling us products and services, and they're run by people, and we can learn more about them. So the last thing I'll say about the Motley Fool is we're a subscription service, and our whole goal is to help you invest better, to help you make better decisions with your savings over long periods of time. And I think that Jeff nicely mentioned the awards that we've won for having a great workplace culture. The truth is we've just sat and learned from every company that we study. That's all we do every day. So we steal their best ideas. And we find that it's a good idea to invest in companies that have a great culture. If you're going to be a long-term investor, you want to know the employees want to go to work every day, are really passionate about the purpose of that business. And so if you just look for companies with great cultures, they outperform the market by a little bit more than 2 percentage points a year. So best places to work is a great place to go to work and a great place to invest as well. And we've kind of built the Motley Fool around some of those principles.
Fantastic. And Chris, you also have a subscription service at Tematica, Tematica Pro, Tematica Investing, which you're the editor-in-chief of.
Correct.
You also have a podcast that you do publish
Yes.
that people are able to download from here in Singapore.
Yes.
It would be great to hear some of the observations that you've been making here,
Okay.
some of the themes that you're covering in the US that are relevant here in Singapore, and let us know where we go into the iTunes store to access that podcast.
Sure. So a couple things. You're right. We are a subscription service as well. The way we look at the world is a little different. The most people tend to look at the world in the S&P categories. There are 10 or 11 of them, I forget these days. We don't look at it that way. We look at the world from a thematic perspective. So we try to look at the shifting landscapes of economics, demographics, psychographics, technology, and some regulatory mandates. And these changing landscapes can produce either demonstrative tailwinds that can power businesses, or if companies are not positioned correctly, they can create headwinds. And headwinds, as we know when we fly a plane, will slow a business down. They will retard them. So we look for companies that are well positioned to capitalize on these thematic tailwinds, pushing their businesses forward. And we have about 17 investment themes. And you asked, since my arrival in Singapore, have I noticed any of them here? And I have. One of them I talked about earlier today was Singapore is much, much further ahead than we are in the United States on cashless consumption. Whether it's Alipay or some of the other factors, services that people are using, QR codes, for example. But the other thing, another one actually, is the connected society. And here, we all know intuitively that the way that we shop, the way we transact, we bank, communicate, consume content is changing. That's all captured in our connected society investing theme. But when I got to my hotel, they had this handy unit, which I had never seen before. And it blew my mind because it was a ride-hailing device, a phone, a camera. It was, I could buy tickets, I could do all these different things. And when I asked the concierge, I'd love to use this, what is the cost? The cost was free, Tom, free, because it was supported by advertising. And it totally blew my mind. And it showed again that, we inside the States sometimes have a US-centric view, but we have to go outside the US. And when we do that, we realize that there are other countries that can be light years ahead of us sometimes for some of these investment themes. It also tells me that thematic investing is truly global in nature. And whether we look here in Singapore, India, China, and some other examples, these 17 tailwinds are blowing, and that creates global opportunities.
With these 17 tailwinds, Kian Soon, if I could ask you on your value investing in the Astral Value Fund, with the headwinds that we saw in the second half of 2016, were there any standout particular great buys in terms of value that you did see towards the end of last year that basically delivered returns into the first half of this year? Or were there any type of investment themes that or segments of the market that were particular standouts?
2016 was a great year for stock pickers. I mean, it was very volatile, the markets. So a lot of stocks are actually undervalued in Asia Pacific. And that provides a golden opportunities for our fund to actually identify a lot of good stocks and very undervalued. And we are actually reaping the benefits of these, picking these undervalued funds as the stocks have already appreciated. We have a good run so far in 2017. And a lot of these stocks have begun to yield very attractive returns to us.
And Joanna, with the overall asset allocation as well, did you find that
with the great rotation that we have seen from basically we went from emerging markets back to developed markets, back to emerging markets. We've had the defensive trades have been lifted. Investors have rotated more into cyclical sectors and segments in the first half of this year. Did that also affect overall asset allocation? Was there more money going into equities than there were the bonds and the corporates, or any particular ETFs and type of asset allocation strategies that stood out in the first half of this year?
Yeah, I think generally the macro environment has been quite conducive for equities overall, because we are seeing rising interest rates, and definitely you don't get into bonds at this time when interest rates are really rising. Right, but on the equities part, it is actually driven by a lot of the global recovery that we have not been seeing for the last 5 years. Recovery has just begun, probably end of last year. All right, if you see all the exports numbers, and even if you see Singapore, we have the best GDP quarter in the fourth quarter, and then followed by the first quarter. So the recovery trades are there. So the cyclical trades, and as well as the tech stocks, and as well as some of the industrial stocks, all started to perform. I think that's also one of the reasons why Singapore actually did quite well earlier in the year. But as we go through the recovery process, I think everybody has this question: is this for real? Is the recovery for real? All right, because like in the past few years, we have been seeing that the recovery has been very short. Is it only fourth quarter, or is it going to be like 2 years from now? So I think right now everybody is pondering whether this recovery is going to be sustained. All right, our view is, yeah, probably it is going to peak in the fourth quarter. All right, so yeah, there's some rotation going on. And also bearing in mind that actually the Singapore market has done so well, right, it might be good to look at other markets right now where the availability of ETFs actually give you a lot of opportunities for that. Yeah.
Tom, are you seeing investors looking at this type of rotation strategy? Is that transcending into investors shortening their holding periods for holding particular stocks or sectors or type of products?
Well, in our view, the holding period for stocks around the world is too short, the average holding period. I think the average U.S. investor holds a stock about 140 days. And that's that's tough during that time period to really assess the merits and the value of the business. And I do think that the stock market's really at a higher philosophical level, not to speak tediously and philosophically, but the purpose of the stock market is to fund innovation and to reward new thinking in society. And so if the way we fund that innovation is with a 140-day time horizon, we're losing touch with why we even have stock markets. And so what we're trying to train and develop ourselves and everyone that wants to be a fool with us is to think, what's the 5 to 10 year trend? Where is the world going? Some of the biggest mistakes we make as investors are when we use, let's call it the rowboat syndrome, where we're looking at where we just were because our back is to the future. And we need to reverse ourselves around and say, maybe I enjoyed reading that, this in this format 10 years ago or 5 years ago, but what experiences will I be having 5 years and 10 years from now? And so in general, those are the companies that I'm looking at, and those are the way that I evaluate trends. But it usually has me not thinking about rotating in and out. Again, in the US, we've got capital gains taxes that are very high in the short term. I've always loved Warren Buffett's suggestion that the best way to have capital gains taxes, actually you have one part of it right in line with Buffett, which is that he thinks long-term capital gains taxes should be zero, so that we reward people who look at businesses. But Buffett's belief, which I love also, is that the capital gains tax rate for holding a stock 1 year or less in the US, Singapore, anywhere in the world, the capital gains tax rate for 1 year or less should be 100%. And then you'll get the function of the markets correct and train people how to think about business. And so in general, we kind of, we don't do much rebalancing, which sometimes is painful for us, but we think over the long term is a more efficient way to do it.
Nonetheless, a lot of these methodologies, and just like the stocks that you were discussing this morning in your presentation, they are, even though we're talking about US foundations and US stocks, a lot of them are very globally relevant. We all know Amazon, we all know Apple, they're big names here in Singapore. in terms of the 5-year trends, particular 5-year trends, are there maybe a few of your 17 thematic segments that you'd like to talk about and share a little bit more that might be a little bit more relevant? Like cashless?
Sure. I mean, yeah. So, I mean, the ones that I think, like Tom, we at Thematic agree that there are demonstrative multi-year tailwinds, and those are the ones that we really like. We're not short-term investors. I was 140 days. I mean, that's ridiculous. That is utterly ridiculous. I was asked earlier about our holding period, and I said on average it's anywhere from 18 months to 2 to 3 years, because it takes time for these themes not only to develop but to reverberate through the business, and to see that flow through on the profit cycle, EPS generation, and therefore the stock price. Sometimes it's faster. You know, we have to be cognizant of that, but we tend to be long-term patient investors. Having said that, there are a couple of our themes that play into that. One is the aging of the population, which, you know, if we look inside the United States, we look at Japan, we look at China, you know, the populations are upside down, if you will. They have people living longer than ever before, and there's a whole suite of issues and problems that arise as a result of that. You mentioned cashless consumption. If we look across the globe, there is going to be, we see no slowdown in that migration. Another one is in our connected society investing theme. We don't think people are going to put the smartphone down. They're going to put the tablet down. They're going to change the way they're communicating, transacting, and all these other things that are a part of that. There are some ones that we think could flare up in the short term, you know, time to time. Scarce resources, for example, focuses in on not just water, the protein complex, and some other commodities like corn, wheat, and soybeans that are restrictive based on supply and demand, but also sometimes weather. So, you know, if you have a corn crop and, you know, you have a really bad harvest because of weather, all of a sudden we don't see demand slacking off. That means we see huge price escalation. What does that mean? How do we play that? So there's shorter term things, but generally speaking, the vast majority of our themes are longer term in nature.
Okay, Kian Soon, with the, I guess the different sectors and these consumer drivers that we're seeing in emerging Southeast Asia, so I guess ASEAN excluding Singapore, have there been any particular standout sectors where your value analysis has really stood out? For a case in point, healthcare. For instance, the healthcare that we have here, we still in emerging Asia have a long way to go to catch up with international best practices, have all the right ratios in place. Are there any segments like that that are standing out, not just from a value perspective, but also from a futuristic growth?
For Southeast Asia, we are looking at consumers spending in healthcare, and we all know that as the income of the average person actually increases, they demand for more and extensive healthcare and medical care as well. And in certain countries like in Singapore, where there's a silver tsunamis coming, you know, there's a growing populations. Healthcare is definitely a critical area. Healthcare spending will increase, whether we like it or not. And this sort of creates a whole spectrum of healthcare companies that is beginning to look very interesting for Southeast Asia. And obviously there is the famous medical tourism that Singapore is very proud to offer to our regional countries. So we see that happening for the past 2-3 years. And going forward, I think it will be interesting. Besides medical tourism, we should look at specialist healthcare service. We all know that specialist healthcare service are very, very expensive. And the fact is, their margins as a business is definitely much higher when compared to the general practices. So this will be the next wave of growth in terms of the healthcare and medical care industry in Singapore.
These have been amongst some of our best performing catalyst stocks in the year to date as well. Dr. Victor Ng from Singapore O&G gave a presentation earlier in the day, and his stock, I think, is very high up in the actual catalyst index. We don't have any exchange traded fund on our Catalyst Index as of yet. We're about to have a new platform, educational and informational platform launched by Share Investor on the Catalyst stocks, which we're very much looking forward to. I might just ask you, Joanne, in terms of what the SGX and the market could do possibly in the next few years to increase the amount of thematical plays available in one security, such as the ETFs that we've seen. We've got the two new ETFs that launched in October, launched in March, that covering the real estate
Investment trust segment, not just in Singapore, but also across the region. Do you think this is an area we could work on a little further?
Oh, what do I want to see? Oh, definitely one of the themes that is going in the US is sector investing. All right, so yeah, people buy into tech sector, but as a whole, as an ETF, so that your risk is actually diversified rather than just getting into one maybe very good stock, but you can also get into a very wrong stock. So sector investing is one of the main themes which is very popular with ETFs nowadays. And yeah, if SGX can come up with some of the sector ETFs, that would be good. I mean, yeah, the ones that is the REITs ETF, which has just started since early this year, is quite popular. Yeah, it has got good dividends and is diversified. And yeah, there's a lot of good research on it. And for people who want high dividends and income funds, I think that's a very good idea. People who like growth sectors, yeah, they could actually get into some of the tech stocks or some even the small caps ETFs, which is actually quite popular in India, where all the valuations all go up, and you know there are some opportunities to go on as well. Yeah, sector ETFs would be one interesting ones to go into. Yeah.
And Tom, with the Motley Fool foundations and the method that you apply to investing, are there any particular sectors that are most suited to the way you look at the world in terms of investing? Are all sectors necessarily equal, or there are some that you think are very highly relevant to what's going to happen in the world in the next year or so?
I guess a few, and again, I am US-centric in my comments, but we do, you know, Fool.sg and our team, Sir Jing and Chin and the whole, Joanna and our whole investment team, I think does wonderful work, but I really have to leave that guidance to them. But I'll say from a US standpoint, and these trends obviously extend well beyond the US, but home delivery is profound. I heard about the Amazon 2-hour delivery experience here, and I think that's going to devastate physical retail in the US. Just absolutely devastated. I really have not spoken to the CEO of a major retail company or heard from people that have that isn't saying we don't know what to do. We genuinely don't know what to do because the foot traffic is down in the retail locations, and what they've learned is that the first layer of people to stop shopping in physical retail spaces were the wealthiest that have access to high-speed technology and are willing to order a luxury good, and if it doesn't work out, have it returned. You know, they presumably, if they're the highest net worth, maybe they have an assistant that can mail it back for them. And so they're willing to make that experiment. And so the highest margin customers have been leaving physical retailing spaces, and that's really hurting the margins. Meanwhile, these companies have long leases that they can't easily get out of. And finally, they were built around foot traffic and parking and driving traffic in the US. They weren't built around home delivery, and Amazon has built its entire system around trying to perfect how to get that to the home faster, less expensively, with more selection and ratings across all their products. At this point, Amazon to me is a total monopoly, and the reason I don't think they'll be broken up in the way that we might think of monopoly would be in the US is that they're beloved by the consumer. I mean, they're not a monopoly that's creating pain for us. They're making our lives much easier, and they're absolutely brilliant. So I would say home delivery and automation are certainly major themes. I agree with the healthcare theme very much, and medical diagnostics, genetic testing, I think is going to have profound impacts. And then last is just how is consumer behavior changing, and how will that impact the solutions that we're looking for? There's a U.S. company that I like very much called iRobot. You may know it. The home Roomba, Brava, mopping your floors. They're automating the lawnmower. I made this joke yesterday. They're automating all of the jobs that a teenager gets paid their allowance for. So it's kind of sad in that way. But another way, it's very, very convenient, and you pay for it one time, and that device just works for you forever and ever and ever. And that's a really great business model, high margin, and I think consumers will be buying those products.
Tom, I know the crowd, I think, very much appreciated the talk about Amazon and being stock specific. So we might take it to coming top down and talk a little bit about particular stocks, Chris. So if there's a couple of stocks in the US that you've seen being totally relevant to the growing consumer value chain, moving from the traditional supply chain, that you'd like to share, that I think that would be much appreciated.
Sure. I echo Tom on Amazon. From a thematic perspective, we look at Amazon as probably the poster child for thematic investing. Everything from our connected society investing theme to our cash-strapped consumer, cashless consumption, to rise and fall of the middle class, to even guilty pleasure. I don't know if you saw this, Tom, but Amazon is partnering with an Oregon vineyard to have Amazon wine. So you can have that delivered in less than 2 hours if you happen to need some wine, maybe. And of course, content is king with what they're doing with Amazon Prime Video. And we've seen the awards that they've won. So without a doubt, Amazon is a poster child. But we also try in our investing world to connect the dots. And I talked about one of these companies earlier. As great as Amazon is, at least for today, whenever you order something, it still has to get delivered to you, or at least to the intended recipient as we get ready for the holiday shopping season. To me, that says that, again, at least for the foreseeable future, companies like United Parcel Service, UPS, have a very, very strong tailwind behind them. But shifting gears outside of that, if we look at some of the economic data that's out there where we see U.S. disposable income coming under pressure, we see the U.S. consumer facing higher credit card debt, facing higher student debt, so much so that the portion of debt relative to disposable income has done nothing but increase. We see a long life ahead, unfortunately, for what we call the cash-strapped consumer. We think that Amazon will be a beneficiary there, but we also think companies like Costco that allow you to buy in bulk will be strong beneficiaries. And at a time when everybody is nervous over the destructive impact of Amazon, Costco just reported their July sales, and in the US they were up 6% year over year, which is mind-boggling when you think about that in terms of overall retail. Then you go one step further with Costco, and you realize that the real profit generation there is their membership income. They're opening up more warehouses. They just passed through a price increase. So that profit generation will continue to grow in the back half of this year into 2018. So there's a lot of positives behind Costco as well. As far as other names that we like disruptive technology names. A lot of people are looking forward to Apple and their new iPhone. We, as investors, do like Apple, but we like the companies that will benefit by what Apple is doing. One example is a company called Universal Display. They are one of the key companies in organic light-emitting diodes. They do chemicals that are used in the displays. They also license their intellectual property. So it's very much a Qualcomm-esque type business model, one that we happen to like quite a bit. And as Apple morphs into OLED displays, they will benefit. As LG and others bring OLED displays to TVs, Universal Display will benefit. As more wearables adopt OLED displays, Universal Display will benefit. And we've seen this before with the LED industry, where we went from backlighting phones to TVs to displays to signage. And that is the roadmap we'll see replicated with organic light-emitting diodes. So we like Universal Display over a long time horizon. And those are just some.
Kian Soon.
All right, consumers, our favorite, especially in terms of F&B. The model we look at is not rocket science. We've seen that in the States in the 70s, 80s, where we see F&B companies opening it up as franchise. They expanded from the east to the west or from the west to the east. And this has happened in Asia in the last 15 years, where throughout Asia, in China especially, as you see the F&B companies setting up more and more outlets. Weekly, monthly, the statistics are there. You can see the shops are opening. You can see whether there are customers standing outside. BragTalk went through this whole cycle in Singapore, expanded overseas to China successfully when you see customers queuing up to buy the breads and all this. These are visible. Why is it important to see things that are visible? If you wait for the financial results at the end of every quarter, probably it's a bit too late, right? When you invest in businesses, you could actually open your eyes to see whether these businesses are doing well. These are the leading indicators where all of us can see. That's why when you go to the malls, it's not about buying what you want. My office is at Suntec. My favorite hobby with my partners is to go around the malls on lunchtime. After our lunch, we take a walk, we look at how each business is doing. That's what value investors should do, right? You look for leading indicators instead of waiting for the financial reports to tell you those numbers at the end of the quarter. You probably miss out on big opportunities in terms of buying stocks at good value. So what is happening, which is what I said is obvious. You see stores expanding. These are very strong cash flow companies that actually could open new stores without taking up loans. Their balance sheet is solid and they are high positive operating cash flow business. This is what we like. There are two counters we like in Hong Kong. One is Shabu Shabu. Again, it's the same model. They sell hot pot steamboats to all these Chinese cities. And you could see that all the busy young working adults going in for shabu shabu, which is a small hot pot, for themselves. It's not the Hai Di Lao where 10 people eat and spend 2 hours. It's an outlet where you go in, have your meal within 15 minutes and out you go. It's very uncomfortable, it's very squeezy, but it's built for 3 turnovers per meal, right? Within 2 hours, 3 batches of people come, they have their meals, they go. Wonderful, right? And what is the secret about this business? You cook your own food. They don't have a chef. It's hot pot. They give you a bunch of raw food, right? You cook it yourself, you eat, and you go. You pay the renminbi in terms of, a cheaper price you pay, but high frequency, high expansion, rapid expansion. You can see the same store sales growing, and it has done very well in the past year. And the next one that we saw was a counter listed in Hong Kong, Hop Hin. Again, fast consumer growth, high growth business, because what they do now is for every consumer business in Asia, where we sit with them, F&B especially, the question is, what is your distribution strategy apart from the fact that you have stores? So what is happening? Deliveroo, Uber Eats, and in China you had the equivalent. 20%, as high as 20% of sales are clocked by selling food in a motorbikes, in a U-pad or motopads. And so if a food F&B business does not have a distribution strategy that is related to, somebody delivering the food to the doorsteps, then probably, is in trouble, right? You ask what apps do you have, who do you actually work with to make sure that food is sent out at a faster pace apart from opening up of stores. So this is what is happening in Asia. And the fun part is you can witness all this, right? You guys can see it. It's not something that's hidden behind. It's not something that nobody knows what they are doing. But these are obvious trends that is happening for the consumers population in Singapore, in Asia. And please, take a good look at it. Look for ideal investing opportunities, and I assure you there are plenty.
Well, last year, I know consumer staples was by far our strongest sector in the market in Singapore last year. I think on a market cap weighted basis, the sector generated a 26% return, while the STI basically remained unchanged and delivered the already high dividend yield that it has. But some segments have continued within the consumer staples, particularly I think hotels, restaurant, leisure, which have a Southeast Asia focus. I know Joanne, DBS Bank did win an award last year. I think it was the Asia Money poll where your regional equity team was ranked first. Were there any particular cores in the consumer sector that were really good for you in 2016 and did continue on into 2017?
Generally, on the valuation ground, we feel that consumer stocks may be a little bit expensive on the valuations. I think generally they trade about 20 to 30 times PE. And of course, that's because they are very strong stocks which has been supported by very strong demographics across all Asia. So I mean, as a long-term place, yeah, they are very good stocks. But some value stocks with small caps, you could also find some, especially those under research. And if it is covered by all these management and research houses, I'm sure you can find some gems there. But if you talk about tech and consumer, I think you really cannot ignore China, right? Because what we are talking about is the most populous country in the world. And if you look at tech, if you look at China, what do they have other than Amazon? You have got Alibaba, of course, right? and you got JD.com. You have got a lot of the listed ADRs in US, which is all very China-centric. And if you talk about consumer stocks, you are actually catering to right now the millennials. That's what we call. Sorry, all the older uncles. But we are talking about millennials spending and how they are using the tablets and how they are using handphones, to transact, to buy insurance, and to communicate. All right, these are the sectors that we think that has got a longer time frame, where you have to look at the new trendy patterns that they are looking at. Do they shop in the malls? Yeah, maybe, but most of them will actually go online. All right, so if you look at this, we think the opportunities are in China right now. We just raised our Hang Seng Index target to 29,200 yesterday. Right now, trading at 27,000. So there's another 10% upside from now. All right, so if you look at China, right now, we think that there's a liquidity bull. Yeah, liquidity bull, especially right now, interest rates in China, probably not more tightening. And in terms of reforms, it will still be quite smooth towards end of this year. So if you look at some of the tech and the consumer sectors, we think the opportunities are in China right now.
So glass is half full for China.
So far, yeah, hasn't overspilled.
Tom, can I ask you, because I know I've heard David say before here in Singapore that he doesn't really, he's not really bothered if the glass is half full or half empty. He wants to know whether he should buy the glass and invest in the glass. But may I ask you, are you glass half full or half empty for the US, which is obviously the biggest economy and a driver of global sentiment? You're at all-time highs. The theme of being possibly at stretched valuations has been brought up multiple times today at the conference. So we'd love to get your thoughts on that.
If I'm investing in the first, I would continue to allocate money outside of the U.S. It's been a very U.S.-centric world over the last 7 or 8 years. It's been a great market, and it's not always going to be the leading market. There's so much great innovation, creativity, entrepreneurship, and business happening in countries around the world. So I think there's so much attention to the largest few companies in the U.S. right now, and so I would probably keep my eyes open and look for companies outside the U.S. that I really admire, that live up to the principles that we've heard here today, like they're growing out of their own cash flows. That's a good thing they can reinvest their money. They want to reinvest. They have a large market opportunity, and they're taking their capital and they're putting it back into the business. This was one of the mistakes about those who've criticized Jeff Bezos and Amazon over the years. That's a very cash flow positive business. They probably did about $9 billion in cash flow last year. It's just they reinvested in the business, so it looks like they're not generating any profit, but he's just playing aggressively, playing offense to grow. So look for businesses that have reinvestment opportunities. That would be number one. And number two, if you're going to invest in the US, I would look for small caps. I would look for smaller companies, the disruptors of the future. Having said that, I'll just say three investment names that I like that will seem to controvert exactly the points that I just made. But I'm a fool, so I'm allowed to. The first is I think Facebook continues to be a great investment going forward. I think social and mobile would be a theme I definitely want us to make sure we're locked in on. And so I think Facebook and Tencent are outstanding investments, even though they're very large companies. Think of the margins of those businesses. They don't have any delivery issues. I mean, they're absolutely, I remember the first time I saw Facebook's advertising tools. It's absolutely incredible. If you're not at a business where you get to look at them, or if you are, make sure you go over to the marketing department and really look how it works. It's unbelievable, right? I mean, you can target men aged 51 to 57 who have been divorced in the last year, have just changed jobs, love sailing, and want to go fishing in the next year. I mean, that may sound absurd, but it really is that narrow. And as we all probably know, but we need to remind ourselves, like every single thing you do on Facebook is tracked and is part of a database that is attached to you, and you are sliced and diced and sorted in ways that it's just such a powerful advertising platform. They have so much information. Same thing with Tencent. And so these are like WeChat, these are very strong cash flow businesses with very powerful brands. And I don't think that that's going to stop, even though they're large companies. Last thing I'll say about them is, I actually think their valuations are somewhat depressed relative to the others because the average investor thinks maybe they're kind of silly. Like, can't they be replaced? Is social really serious? Like, it's kind of a joke. Whenever I survey people in the US and ask them to rank the big companies, Facebook is always ranked last because it seems the most absurd and childish. It's not real. It's not creating a real product. So I really think Facebook and Tencent will continue to be very good investments. The only other one I'll mention is a company called Arista Networks. And Arista Networks is basically software-defined networking in the cloud. They compete with Cisco and Cisco Systems. And one of the biggest indicators of their success is that Cisco keeps trying to sue them. And Cisco is not a company that's ever been litigious. And I've talked to some people that are very knowledgeable, and they're like, that is one of the strongest indicators of how disruptive that company is. They are terrified of Arista Networks. And it's the founder of that company was the first person to invest in Google. He invested $100,000, and I don't think he ever sold. So they were able to self-fund that in the middle of Silicon Valley. They never took venture capital. For 4 years, they developed their product and did not release it to the market. These are all very good indications that these are brilliant people that are trying to win something over the next 20 years. It's been an incredible stock. It's up 3 times in value in the last year and a half. But I think looking 5 years forward, they're very tied to mobile device networking, where Cisco was very much computer systems in offices. And I think Arista is a big trend of the future.
Thank you. And Chris, could I ask you can you see this great trend resonating over here in Singapore? I guess there's 3 things I'd like to share.
Sure.
First of all, in the year to date, in the first 7 months, our information technology sector has been by far the best performer. It's up more than 40% on a market cap weighted basis. But the traditional strengths are more the semiconductor and the hardware providers. But nevertheless, the majority of these companies are net cash positive. So they are in good stead to help with the digital disruptor industry kick off. And there is a lot of government-backed efforts to build a good platform and a good industry foundation for these companies to sprout. Do you see this potentially being strong over in this part of the world, particularly when in our part of the world, Southeast Asia, 650 million people, Google and Temasek released a paper last year that showed that 120,000 people in Southeast Asia come online for the very first time every day from then to potentially the end of 2020?
That's a big question. So let me see if I can get to the heart of it here. What you're asking me is, as more people come online, we're going to backfill and see a lot of demand in these markets for companies that are writing these particular trends and themes, correct? They're cash flow positive and they have the backing of the government behind them, right? So I don't know these specific names, but I can say without question that if I were to sit down and roll up my sleeves, those are some of the characteristics that I would want to be looking for. Would I have to think about the valuation and their precise positioning? Yes, I would. But anytime you have, one of the things that we look at Tematica is regulatory mandates, and by that a twist on the role of government getting involved in supporting an industry. So one of the reasons why we like Applied Materials, for example, is that in China they are being very aggressive about developing the in-country semiconductor market. And that's actually very good for Applied Materials semiconductor capital equipment. There are other reasons as well. The proliferation of chips. As I say, chips are the fabric of our lives, and we look at what's going on with the connected car, the connected home, the Internet of Things. Applied is also the manufacturer of that organic light emitting diode display equipment. So there's a lot of reasons why I like that, but that same dynamic, if what I'm hearing you say is happening, then I, as an investor, I'm interested in looking at that, subject to what the valuations are.
Do we want to open the floor to some questions? Have we got a microphone potentially? Yeah, does anybody have any questions? Thank you. I think we have approximately 10 minutes left. Yep.
Well, my name is Sunny. You're so bullish, so buy stocks on and on forever and ever and ever. But I've been looking at the blogs. One of them is Mark Faber, Dr. Gloom. Say the crash is coming this year or next year will be worse than ever. There's another person I read in the blog, Jim Rogers, this year or next year. Say buy gold. silver. So comment on this. Is a crash coming, or you buy and buy and buy, measure and so forth. Buy forever and ever for your sons and sons and sons and sons.
Yeah, I think the question, Mark Faber, who 2 years ago was on this panel, and he was talking about obviously the role of gold in a portfolio. World Gold Council is active out here in Asia, and they recommend that for a portfolio to reduce your tail risk for when you have the big moves, you should probably have maybe 5% of your portfolio to gold. With the bullishness potentially of the IT and the fintech push, maybe people are saying 5% Bitcoin rather than 5% gold. Is that relevant? Do you have maybe yourself and Tom could?
So I would say that, you know, in a diversified portfolio, you know, should there be some exposure to gold? There should be. If we were to look at the U.S. market, you know, into the back half of the year, I would say that I'm a little concerned. You know, you mentioned that the market's trading at near all-time highs. The valuation is stretched. Expectations are rather high for earnings growth. And I think if we look at the backdrop, particularly the U.S. economy, and some of the underlying economic data about business investment, about the strength of the consumer, there is some reason to be concerned. At the same time, we've also got, you know, I would say, maybe not quite disarray, but some uncertainty in Washington over what's going to happen now that we've tried 3 times to repeal and replace Obamacare. What's going to happen with the tax reform? When are we possibly going to start rebuilding infrastructure? We've got the debt ceiling we've got to contend with. We've got elections that are going on. So I think at least going into the back half of the year, as we face with some of these uncertainties, maybe that 5% may be a tad higher, 6-7%, because gold is a natural hedge. So if the market does come under some pressure, it should actually outperform.
Joanne, your asset allocation strategy at the moment, does it have gold in there?
Yeah, we are. On bonds, we are underweight, all right, because of rising interest rates. Equities, we are positive, but more positive in Europe, neutral in Japan, and more positive in China, Asia in general, and also underweight in U.S. equities. So when we thought about buying, what we are talking about now is like more diversified portfolio. You know, like when you cross the road, you know it's dangerous, but that doesn't stop you from crossing the road, right? Because you want to get to the other end. So in terms of why you want to invest, I think right now you either invest for a longer term, you know, you buy something for your children. You know, if you then think about how Facebook and Amazon trades today, you know, when you think about it 10 years ago, would you want to buy one for your children, you know, for them to keep? So yeah, think about long-term investments, but at the same time, because there are opportunities which has been driven right now by a global recovery. I mean, if you talk about Singapore market, hasn't been doing very well at least for the last 5 years. All right, we have got a crash almost every year, all right, at least a 10% crash. But this year, so far, so good. So everyone is like, you know, when the crash will come. But in fact, right now, at least it has been supported by good earnings and also supported by some monetary easing. And end of the year, probably we will get some reversal in terms of monetary easing, in terms of QE. So yeah, there's some uncertainty, all right, but what we are talking about is more diversified. And gold in general, we believe that it is more of a tactical trade. I mean, it is like more technical nowadays because the real demand for gold, especially from China or from India, isn't there anymore, right? And if you look at the technicals, right now it's probably quite inversely correlated to the US dollar. And if the US dollar weaken, yeah, we think that gold should do well, but there's something to watch out for. So more technical charts on gold rather than looking at it as investments. Diversified, yes, yeah, we think that is a good diversifier in terms of defensiveness. Yeah, should be part of the portfolio, but not too much.
Kian Soon, do you see any potentially defensive segments or stocks with the single-digit PE but the double-digit ROE that could potentially be in your value portfolio?
Wow, that's a challenging one. The companies we look at typically are screened according to those criteria. unfortunately, I think for the last quarter, you are getting less and less because a lot of the stock prices have actually rise according to the market things, the market situations. But we hold stocks for long, and good times and bad times just provide opportunities for you, especially when times are not good. The way I say it is we actually bought a lot of stocks, and people were saying we are crazy, but we hold on to them even until now. So the sectors that we like have not changed, and these are the consumer sectors that is related to Asian demographics, i.e., childbirth, because how many parents will have 10 kids these days? It's one, right? And you give him or her the very best. Childcare, baby care sectors, as well as the sectors that is concerned with food, because you need to eat 3 times a day minimum. You need to go for your coffee breaks at Bread Talk, for instance. And these are the sectors we liked. Yes, the prices have increased. Probably, I think, some of these stocks that we are looking at value have increased. Bread Talk has increased 55% in the last year alone, right? They were sorting out some of the challenging issues last year, and it was a good opportunities, to get in, but probably now it's a bit expensive. So market situations, yes, prices goes up and down. Be disciplined. When you think that the market is a bit hot, don't rush in even you find a good counters. The names are always there. The companies is going to be there. You can continue to observe how the business situations, and you get in at timely manner. You're not a fund. As a retail investors, the ultimate advantage you enjoy is you can keep the money in your safe until you feel like buying a stock. While if I do that, my investors will ask me like, why am I asking you to invest when you are putting cash, and not investing? That is my challenge, right? As a retail investors, you don't have such challenge. You find a good business, you take your time to do your analysis, you take a look at how the business performs, take a look at the financials after 3 months, and when the timing comes, when you think that the market is fairly beaten up and the company is valued cheaply, then go in, right? Timing matters, of course, right? If you decides to put all your money in a basket when the stock index is all-time high, it's definitely not a very wise decision. But at the same time, you must be disciplined and committed enough when you see crashes in the market and say, look at the list of good companies that I have gathered over time, and is it time to look at them again? How are they doing in a crisis? A lot of companies have performed very well in all these Asian crisis troughs that we have seen. But the question to ask is, do you dare or do you have the courage or discipline to buy those stocks at that time?
On the timing, I think we're on to our last question. Tom, it's going to be for you, and I might just rephrase that terrific question we had before. Were you bullish on Asia before you got on the plane and hopped over here? And if so, are you still bullish on Asia as an investment base, as an overall market?
Absolutely. We were in Tokyo about a week and a half ago, and in Hong Kong 4 or 5 days ago. I don't know what day it is or what time it is, but I love being here in Singapore. And I mean, I think the valuations are attractive for businesses in these markets. And I love the question about crashes. It's always it's part of our psyche. It's out there. Everyone's always wondering. And so I think the big question is what do you do to prepare for it, and what are you going to do when it happens? Because it's going to happen at some point. Maybe it'll be 14 years from now. Maybe it'll be Monday morning. Nobody knows. But if a 25% decline or 30% decline in the value of equities is going to change your approach, you should change it now. Don't change it then. That's going to be, you're going to be changing it from a position of weakness. Move from a position of strength and simulate a 25 or 30% decline right now when you go home, and ask yourself what you're going to do differently. And if what you're going to do differently is sell, well, that's a real problem. If what you're going to do differently is, I wish I could buy, but I don't have the money, then you probably want to build a cash position up right now. But I think that the markets, the Singapore market, Hong Kong, Japanese market that we've just studied and been studying, and we're launching services in Hong Kong and Japan. Obviously, we've been here for a couple of years, and we'll be here. The Motley Fool aspires to be here for the rest of our life in every market that we enter. And so to learn more about the entrepreneurs and the businesses that are being created here, Fool.sg is about investing in Singapore stocks by Singapore born and raised investors thinking long term about those companies. That's how we think, and that's how we do our research. And so when I'm talking to Sir Jing, he's like, the valuations are attractive. There are wonderful businesses to buy right now. I should hand him the microphone to share a few of those names, but you can check in Fool.sg. But what I'll say is that, yeah, I think the markets are attractive, and yet I would always assume a 20% decline is coming. I would just always assume that and ask myself, what would I do differently if that happened, and why am I not preparing for that right now? But I think from a long-term investment standpoint, this is a wonderful market to be invested in, particularly when you can find the Singapore companies that are able to go outside of this market into other markets throughout Asia and around the world. And more of those businesses that are created, the better the opportunities are for investors like us.
Thank you so much. And Chris, just 30 seconds quickly. For the investors that want to hear about your observations next Monday when you return back to the States on your trip here, where do they go?
Yeah, so what you're referring to is every Monday we have a Monday morning kickoff. It's a wrap-up of the prior week and an outlook of what's key. You're asking me this because I already told you what's going to happen. Because I'm traveling, this will be one of the few weeks that we don't publish a Monday morning kickoff. So we will actually be having a supersized edition on the 14th when we're back in publishing. But odds are we will have a podcast out next week, and you asked this earlier, you can go to tematicaresearch.com and find it. You can find it on iTunes, Stitcher, and some other podcast distributors. We talked a little bit about it when I first got here. Odds are when I get back on Tuesday, when we record next Thursday, we'll have something out sharing more of my thoughts and observations on what I found here in Singapore by the end of next week.
Really looking forward to listening and reading it.
Oh, thank you.
Thank you. And Joanne, we obviously are looking forward to reading your reports as we publish them through the SGX My Gateway newsletter. That's my plug.
Yeah, I got a session tomorrow, presentation.
Yes.
At 2:15 if you want to come to hear me.
Thank you so much. Thank you, Chris. Thank you, Joanne. Thank you, Kian Soon. Thank you, Tom.